Hello, welcome. This is Roger Royce, host of the 10,000 Startups podcast, Legal Strategies for Startup Success, where each week we bring you original content with subject matter experts on topics of interest to startup companies. And this week, we're going to talk with Randy Lieberman about R&D credits, R&D tax credits. Now, before you hang up and say that, gee, I'm a startup company, I don't pay any taxes, why do I need to care about R&D credits? Oh, hang on, because Congress has made this attractive even to you, a startup that doesn't have any income and doesn't pay any income taxes. And we're going to hear more about that as we get into this. So first of all, I want to thank you for being here, Randy. This is an important topic that people just don't seem to know enough about, I think.
Thank you. I appreciate being here. I will say, rarely does a day go by when I don't talk with somebody who was surprised that this credit existed, much less they were a potential beneficiary.
Yeah. Well, let's kind of level set the stage here. So tell me, big picture, what is it? What is the R&D tax credit?
So at the highest level, the government's looking to promote innovation. And so the R&D tax credit is really about encouraging businesses to engage in innovative activities where they invest in research that can lead to new products, new processes, or software. The whole initiative is to foster innovation within the United States.
Okay. So what's the objective? As you say, just to foster innovation in the United States? That's the main idea? That's why we have it?
Certainly that is the core of it. The idea is to really drive productivity improvements, to create new industries, to enhance the U.S. global competitiveness while driving economic expansion. So with this credit, there's a benefit of the skill forces being improved as well as the knowledge-based workforce.
Okay. And this is a credit. Tell me how it works. It's a credit to get income tax, but what else? How else can a startup company use it?
So from a startup's perspective, it's particularly useful in that it will enable them to invest in funded research, and they can capture a reduction against their payroll taxes. And that's really, from a startup standpoint, as long as they meet the criteria, which is either there's a threshold based on their age or their level of annual revenues. But the big benefit for them is that it facilitates, they can be pre-revenue, and they can certainly be not yet profitable and still benefit from offsetting costs. So it's an opportunity for them to expand their investment capabilities through capital that's provided vis-a-vis the credit.
Yeah, so let's pause on that for a minute, because that is really the real guts of this. So you're a typical startup company, you have losses, you don't pay any taxes, you reinvest your earnings. VCs don't want you to have income because they don't want you giving their money to the IRS. And then on the back end, you have a sale at a big, huge gain that we accept from tax under some other provisions. But in the meantime, you're going to have payroll. And if you got payroll, you're going to be paying payroll taxes, no matter how unprofitable you are. So what you're saying, this is a way that we can use the government's money, the payroll tax money, to fund the company's R&D, research and development, right?
That's absolutely correct. I like to explain it to people that it's a hidden treasure. Those dollars that they're investing in innovation, they could look to as being worth effectively $1.10 additional capital that they can invest to stimulate new experimentation, take on additional risk. The key is that it's technical innovation to, really to create the innovation that they want to drive their business forward. And as you know, all businesses are driven by innovation. It's hard to build a company. It's hard. There's a lot of aspects to it: sales, marketing, human resources, legal. The most important area is how to innovate, how to differentiate their value proposition.
Yeah, you said a mouthful there. It's got to be technical and it's got to be new. So as I understand it, the credit is really based on increasing the amount of over the prior year, right? The increased amount of investment you're putting into R&D, isn't that right?
It is about increasing, but depending on the stage of the company and how long they've been around, it's the full value that they're investing. And so it's not strictly, there's a couple of different calculations that go into this. So by looking simply at the increase, you miss a lot of the value that's attributable. The rule of thumb that we like to express is for companies to think about, for every dollar, or rather, let's just say for every $1 million that they would invest in research and development, the credit's approximately 10%. So $100,000 in available credit that they could use towards reducing their payroll expenses, or in the case of companies that are profitable, to offset taxable income.
Okay, gotcha. Now, and then the other thing you said is that it's got to be technical. So it really is research and development on something that's technical.
That's correct.
So it's
and
technology.
It's technology oriented, but it's not strictly for technology companies. There's a lot of other industries that are huge beneficiaries. Manufacturing, agricultural. Certainly the obvious ones are the technology companies when people think about right now AI, but they don't often think about the manufacturing company, the company that's come up with a cost engineering or an improved process. All of that work that's being invested in is also eligible for the credit to the extent that that work and investment is taking place in the United States.
Yeah, who is an ideal target for this?
So it depends. So relative to startups, it's going to be any company that's investing in a new or improved product, a new improved process, an invention, or a software item. Those companies are going to be less than 5 million in annual revenues and less than 5 years old, such that they can offset their payroll tax. Beyond that, it's any company that's investing in innovation, though. And if they are more mature or they're past that threshold from an age standpoint or from a revenue standpoint, they can use the credit to as a carry forward to reduce current taxes as well as taxes going forward for 20 years.
Okay, and can you talk a little bit more about what type of investments would be eligible to qualify for the credit? I mean, is it, for example, if you pay your patent lawyer, you pay your lab fees, I mean, what exactly qualifies?
So it's a great question, and one that sometimes creates confusion, in that a lot of startups think about historically they could write off expenses based on 174 elections. That changed with the taxes that was passed during Trump's era, in such that companies now need to amortize their costs. The credit that's associated with research and development, however, is not as expansive. So you can't take advantage of certain fees like patent filing fees, for example, or reverse engineering. The core of the value is in the labor costs. And so the primary contributor is, what is the labor, the work that's being done? So that would be W-2 taxable, excluding fringe benefits. That would be any type of supply costs. That would be cloud costs, which are increasingly relevant these days. If someone's using AWS or Google or Azure to develop their solutions. And then there's any type of third-party costs. The contract research is a significant value as well. The cost associated with that, where you would capture from a qualified research 100% of one's own labor in the W-2, when it comes to contract research, it would be captured at 65 cents on the dollar.
Okay. And can you tell me more about that? How do we calculate the credit? I didn't quite get the math.
So the simple math, without getting too technical, is to think about it. It's on the federal side, it's 8 to 10%. And so that's why we would use a rule of thumb of 10 cents on the dollar of the investment. Depending on where someone is located, there are 39 states that also have a derivative of the tax credit, such that you could be up to another 5-7% that is available in terms of in the calculation. Depending on the state, they might have. California is eligible. It is.
Okay.
Texas is eligible. Colorado. It's interesting that depending on the state that you're in, sometimes the states will want to incentivize certain geographies or certain industries. And so that's what happens in terms of being able to capture that additional credit. And so we will have to look at that on a state-by-state basis, whereas at the federal level, again, that applies across the country.
I see. So here in California, I guess we could say it's worth maybe roughly 15 cents on the dollar, right?
It would, again, depend on California. I'd have to clarify. I'm not sure if it gets you to the full 15%, but certainly north of the 12 cents on the dollar or the 10 cents on the dollar. So I would say more 12 to 15 cents.
Gotcha. Okay. Got it. And maybe can you give me like an example of where you've taken this into a company and what the result was and how it worked? That made a claim.
So Yeah, I'll give. In fact, I'll give you an example from a California company, which we did not too long ago. They were actually in the agricultural space, and they were using drones to scan the fields that they worked within, that they owned. They would capture the data off of the drone. So they wrote software to capture the data and then process it in a certain manner so that it could plan out where they were going to plant additional crops, as well as to do planning relative to harvesting. The company had also built robots to facilitate in the harvesting effort. So they were able to capture information off the drones, the data software, as well as like a manufacturer building robots to aggregate a credit in which they were then able to, because this was a startup, reduce their payroll taxes. And they had a combination workforce of full-time employees as well as independent contractors.
Okay, got it. Great. That's a good example, because we see a lot of companies like that here in Silicon Valley. I mean, pretty much every company I deal with is a tech company, and they're all building something new and innovative. And that's where most of the spend goes. It's where most of those venture dollars go. So it's great to know that they're getting a little help from the government on that. So
absolutely. And it's beyond just basic software. I think most people mistakenly assume that's going to be AI. And if I'm not doing AI, I'm not a beneficiary. But it's really across the spectrum. So I previously worked for Nestle, by example. And any type of new formula that's from a food on alternative meats or proteins to a formula that you might put on your body, as long as that development work was done in the United States, it's eligible for the credit as well. So it really is a very broad-based, from technology to manufacturing to consumer packaged goods. And there is no restriction in terms of the industry. There are certainly industries that are more favorable based on just the nature of what they do from a innovation standpoint.
yeah, okay, got it. Sounds complicated. Sounds like a lot of work. Sounds like something my cash-strapped startup companies who are treading water to keep their heads above, just to keep their heads above water and stay in business, might not get around to doing. It might be pretty far down on their to-do list. How much trouble is it? How much effort is required to claim this credit?
It really isn't as much trouble as it sounds. It's definitely complicated, and you definitely want a team that has worked on this extensively. With that said, though, for a small company, you're going to have a smaller number of projects. The information that we would need to aggregate and collect is going to be related to who's the labor, what was their time spent. If there wasn't time spent, come up with a way of analyzing the associated time, and then looking at the individual projects. And we have a lot of processes to reduce that effort. Timing wise, we typically will say that a credit might take anywhere from 2 to 4 weeks in terms of us aggregating the information. That said, for a smaller project, it may be well south of 2 weeks based on just the volume of projects and the impact that we're trying to analyze. We'll also say to companies, especially when they are worried about just their resources, it's not about capturing every dollar. It's about capturing the value that's there and focusing on where it's material and meaningful.
Okay. And at what point do you think a startup company is ready to reach out to someone like you and say, hey, I want to see if I qualify for this credit?
So it's going to depend on the company in terms of what's meaningful for them, and we will spend time and we'll give an initial estimate based on the work and asking certain questions. So we have kind of a provisioning process. With that said, we've done credits that are as low as $50,000. And the reason we've done this is because we've recognized that they were positioned for much faster growth. So I'd hate to miss out on an opportunity, especially if companies, I always like to say if companies are in a Series A, that's probably a good place for us to begin talking with them. And the way that the credit's structured for startups is it's for the first 5 years, it's up to a certain amount that could be offset relative to their payroll expenses. That number used to be $250,000, but starting in taxable year for 23, that's now $500,000. So it's pretty meaningful impact. When you think about a startup, and I always, having been in that seat before as a CFO, it's like oxygen, and I use the analogy often to think about someone being underwater and holding their breath. That's what it's like for a startup CEO, CFO, who's trying to make payroll, to be able to have the additional resources. It's oxygen for them.
Yeah, absolutely. Is it a refundable credit? Do they actually get money back? Government sends them a check?
So in the case of the startup, they're offsetting payroll. It's payroll taxes that they don't have to pay. So So if you think, so after they make their filing, and it has to be done on a current return, the very next quarter, there will be an election against their payroll taxes, and it's money not going out the door. So it's even better in that regard. That
I see.
said, if it's a more mature company, is refundable. And so we can go back for more mature companies if they're going to apply it towards their taxable income, and we can do amended returns for any open return, so up to 3 years. And that's, in my own experience when I was a CFO, that's how we were able to capture a very meaningful value. We were able to capture over $1 million in previous investment when we did the amended returns, but at the federal and state level.
Gotcha. Okay, got it, I think. So is there anything else our listeners should know about with regard to this credit that we haven't
The most
covered?
important, the most important thing to understand is it's a hidden treasure. It's a value that the government wants you to take advantage of, because the government truly wants you to innovate. It's not a temporary credit. It's been around since 1981, albeit it was temporary and not made permanent until 2015 with the PATH Act. And at that time, that's when it was extended such that startups could really benefit, because now up to that point, you had to be taxable. And at that point forward, you could then offset, companies could begin to offset their taxable, their payroll taxes. And that's really the huge opportunity for a startup, is really turbocharged dollars, how to put those dollars to work and have them extend the runway so that they can achieve a higher valuation and achieve more milestones.
Okay, gotcha. All right, last question is, how can people get a hold of you if they want to learn more about this credit and how they can get these dollars, these pennies from heaven?
So there's two, they can either go online at earned, and it's our company's EARND.co, or they can call and have them call me, and we'll put a team on it. And I'm happy to give my phone number, which is 214-280-9227.
Okay, and I'm going to put all this information in the show notes
Fantastic.
so people will be able to find you. All right, well, Randy, I want to thank you for taking the time to talk to us today, to talk about this hidden treasure that startup companies might not know that they're sitting on. And this is Roger Royce. I'm the host of the 10,000 Startups podcast, Legal Strategies for Startup Success. And what's better for startup success than getting some free cash from the government?
Absolutely. We would love to help it earned.
Okay,
So
thank you.
again, thank you so much.